In the 9 years I spent working in asset management, I worked directly with some of the wealthiest investors in the country. And the thing that struck me most wasn't what they invested in, it was how they thought about it, the behaviors, the discipline. Today I'm going to share 6 of them, because most of these are rarely spoken about on YouTube. Most investors will check their portfolios weekly or even daily, and accessibility to investing platforms has never been higher. It's so easy nowadays to check how much money we've got or what that day's return has been. And the trait I noticed with every serious investor that I worked with was that they genuinely didn't care for short-term moves. Not because they didn't care about the money, but because every investment decision that they made was making it for the long term. They were thinking in decades, not years. Every decision they made, they calculated the risk before investing, and they never rushed into a decision. It wasn't about trying to time the market and rush into something that they weren't fully confident with. They were thinking 10, 20 years time. So whether you wait 2 weeks or 2 months, it's not going to make too much difference in the long run. And the other thing that's imperative with this is that you have the short term covered, so you're not forced into a decision. So you have an emergency fund set up. If you lost your income, you don't need to sell any investments. And even having some more shorter term savings goals. So you don't just have one investment pot that covers both your saving up for a holiday in the next couple of years, but also your retirement in the next 20 or 30 years, because you want to keep this as separate as possible. You want to invest into investments that you can afford to ride out some volatility. You may not see your return in the next 3 or 4 years, but you know in the next 10, 15, 20 years, you're going to get a really solid return. But in order to have that ability to ride that out, you don't want to be even thinking about the possibility of selling it. And that's why pensions end up being such a great investment, because you're forced not to touch it. A lot of investing advice centers around the compounding benefits, for example, using the rule of 72. So if you took 72 and divided that by your annual return, this is how many years it would take to double your portfolio. So if you got an average of 7% per year, it would take you roughly just over 10 years to double your money. Likewise, if you're able to get 10% per year, it would take you just over 7 years. But that only works if you stay invested. And that's partly why over the past decade, the average equity fund investor has returned 9.8% annually, compared to 13% in the S&P 500. And for the average asset allocation investor, they earn closer to 4% compared to approximately 8% for a balanced 60-40 portfolio. So put some barriers in place that prevent you from making constant decisions. The same way that you don't suddenly sell your house if the price drops, because of all the barriers and the costs involved in doing so. The same way that you can't sell your pension if the value drops. You have to keep it until you retire. Most investors will just invest when they remember to, or when it feels safe, or when they have spare money. That's not a strategy, that's just hoping for the best. The best investors are ones that can remove themselves from the equation altogether. And that means implementing some rules. So not only can you automate things like your contributions, but also decisions around things like rebalancing. So if you've got a portfolio that needs rebalancing back to its initial weights, one of the biggest mistakes I see people make is rebalancing too often. They do this because they want to keep their portfolio split perfect. But the problem with this is that you're not letting winners run. There's a reason that they're outperforming and moving away from those weights in the first place. Of course, you don't want to let that move too far, and that's where you need to implement some rules. There's 2 main ways that you can do this. The first, setting a specific percentage that it moves away from that weight, and then when it hits that trigger, that's when you sell and you rebalance across the rest of your portfolio. The other, and this is what more commonly used with the best investors, is that they set a time frame, whether it's quarterly, biannually, or even once a year, that they'll look at their portfolio regardless of what's happening in the markets, and they'll rebalance. And by setting that time frame, you're taking all emotion out, you're not looking at what's happening in the market, and you're just making a clear decision. And after all, the whole point of investing is to provide freedom. Your most precious resource is your time. For most investors, the more time they put into their investments, they don't actually get a better return. And this actually reinforces the first behavior and that long-term mindset, because when there's nothing to do, you're more likely to forget about it and stop watching. There's a myth in investing that the most sophisticated investors hold the most complex portfolios with dozens of positions. In fact, I actually noticed the opposite. The more experienced someone was, the simpler their portfolio tended to be. And these days, most retail investors hold way too many funds, often doing the same thing but with different names. And when they're adding a new investment to their portfolio, they're not looking at how it might complement the other areas or even overlap with the other areas. And then you get to this stage where over the years, you just constantly add new investments depending on what's popular that month, what's been returning well. And you end up with this plethora of different investments that don't really fit together. And actually, in a bid to be diversified, you've actually become less diversified because you've got so much overlap. All that happens is this means more decisions, more rebalancing, more costs, more cognitive load. And none of these things improve returns. It doesn't have to be just 3 investments, that's just an illustration. But simplicity also means you actually understand what you own. And that affects how you behave during crashes. Because if you don't understand your portfolio, you're more likely to panic sell. If you can't explain why you own each fund in one sentence, you probably don't need it. A good rule of thumb is that if your portfolio is too boring to discuss in social situations, you've probably done it right. Complexity in investing almost always benefits the person selling it, not the person buying it. The slogan "time in the market beats timing the market" doesn't mean you need to rush into an investment, but once you have decided what you're going to invest into, in most cases, you just need to pull the trigger, not overthink it. It's of course human nature that we want a discount. We don't want to pay full price for anything. It's like if we're buying something online, that pain of having to pay full price for something because we can't find a discount code. It's exactly the same with investing. We want to get good value on our money, but we can wait around for a dip that may or may not come. Especially for a long-term investment, that volatility within a few weeks will be so small that you might not even see it on a long-term graph. And it can be even worse if you try to time the market when you're already invested. You may feel because the market has gone up quite a lot recently, you want to time it because a dip must be coming, it's overdue. But that means you have to time the market twice, because you have to time it knowing when the best time to get out is. And of course, you have to time it knowing when to get back in. And that cost of not being in the market can really add up over a long period of time. This chart shows that over the last 30 years in the S&P 500, if you missed just the 10 best days, your returns would be 56% less than if you'd stayed fully invested throughout that whole period. And if you missed the 30 best days, you would have 84% less in your account. Now, when I've shown this chart in the past, some people have said, oh, well, doesn't that also mean that you missed the worst days? And well, that's absolutely true. But there's 2 things here. First, if you're fully invested, that amount there includes those worst days. You haven't sold, you've just ridden out. And also what you would tend to find is that the best days tend to follow the worst days because they tend to be those V-shaped recoveries. But this also reinforces the point about staying consistent and why a lot of investors underperform the market. If you invested $1,000 in this case 30 years ago and you held that until today without doing any changes, you'll be sitting on just over 192,000. And that's an absolutely incredible return, and it shows you what's possible. But of course, this also involves you having to ride out dips, corrections, crashes, recessions, the lot, and not have the fear and the worry to sell an investment. So how can you put this into practice? Well, the first thing to acknowledge is that it's never going to feel like a good time to invest. Even if the market is coming down and you get that discount, it won't feel good because you'll be worried about it continuing to go down. If the market is up, it's going to be the opposite approach. You're going to feel like it's too expensive, even though you might be confident in the momentum. And if the market's just moving sideways, well, it's just going to feel boring and not exciting. And if you're investing regularly, then you're going to average into this investment anyway. So even if it does chop around and it's quite volatile or it even comes down, you're going to be getting a better price because you're averaging in. If you've got a lump sum to invest, this can be slightly different. And there's 2 main trains of thought here. If you were just to look on paper, it would say get the money invested as soon as possible because over a long period of time, markets tend to go up more than they go down. And if you're comfortable with doing that, then you absolutely should. But in some cases, it can be more beneficial having a more balanced approach. More so you balance your own emotions as well. For example, say you invest half of the lump sum right now, and then you spread out the rest over the next few months. Because then you can take advantage of having some money in the market, getting in early. But if the market does decide to be volatile or it comes down, you know you've still got more money to invest and you can get in at a better price. This is less so about taking action on an opportunity, but more so about reframing how you treat that volatility. If you're already investing regularly, in essence, you can see this as a sale on things that you were going to buy anyway. And for me, this really reinforces the importance about having that confidence in the investment in the first place. Because if you've just copied someone or you've read an article about something that's performing well recently, you don't really know exactly why you've bought it or the potential benefits of this company or this fund in the long run. So when you do have a period of volatility and there's fear or doubt in the markets, that's when you're going to panic and make bad decisions. If you set out really clearly about what you want to achieve from this investment, you know exactly why you've invested into it, then you're just going to see this volatility as a little blip. This really all comes back to that point about being consistent. And that's why this behavior is so important, because it's not necessarily something you need to action. It's more so about reframing that emotional experience. And that's what most of investing is. If you're in the accumulation phase, you want this volatility. If you just had a straight line moving upwards, that would be bad for you because all you're doing is just buying at a more expensive price every time you invest. If you can reframe it to volatility is just the price we pay for long-term returns. Recency bias is the tendency to assume whatever's happened recently will continue to happen. It's one of the most well-documented cognitive biases in behavioral finance, and it costs investors a huge amount of money. It's why people piled into US stocks after a decade of outperformance, why they abandoned emerging markets after years of underperformance, and why they piled into crypto last year. But the thing I noticed with the best investors I worked with is that they had this near automatic skepticism towards what was popular. Not to be contrarian for the sake of it, but a genuine understanding that markets are very cyclical, and that the best performing asset over the last decade is unlikely to be the best performing over the next decade. It's very easy to look at the last 10 years and feel like that is the normal, but we forget that it wasn't always like that. And for a lot of new investors getting into the market, they started investing after the dot-com crash, after the global financial crisis. And a lot of this does come with experience. Obviously, the longer you've been in the markets, the more recessions, the more crashes, the more recoveries you've seen. But you've also seen the more cyclical side of the market. I think a lot of people forget in the 2000s, after the dot-com crash, that was known as a silent decade for US stocks. This is when emerging markets were booming. And coming out of that crisis from 2010 onwards, we started to see it reverse, where emerging markets would take a backseat and big tech would take over, where US stocks would start to rally and companies like Nvidia shot to number one of the most valuable companies in the world. And more recently, in the last 6 months, we've started to see that rally peter out. Investors are now looking at more value plays. Indices like the FTSE 100, written off as dead by many investors, actually outperformed the S&P 500 last year. It's natural instinct to chase performance. After all, I bet when you look at a fact sheet, the first place you go is at past performance. And for a lot of people, that's how they decide their investments. But this has to be the most reliable way to consistently buy high and sell low. If you have a diversified portfolio, an easy way to counter recency bias is by rebalancing it back to your target allocation. That's because it forces you to sell what's run and you have to buy what's lagging. And that's the opposite of what your emotions want you to do. Ask yourself honestly, is my current portfolio reflecting a long-term strategic view? Or is it just full of last year's best performing assets? It can be both, but if it's just the latter, then that's recency bias at play. I run a community where we can get into this in more detail. Link in the description if you want to check it out. I hope you found that useful. Thanks for watching, and I'll catch you in the next one.